I don't think people understand how crucial it is to recession-proof their portfolio. Hey everybody, Richard here, welcome back to the channel. Today, we're diving into a topic that's been on everyone's mind lately: how to protect your investments during a recession. Let's be real, nobody likes thinking about economic downturns, but the truth is, they're a natural part of the economic cycle. But hey, that doesn't mean your portfolio has to take a nosedive. We're going to explore the top 7 assets that have historically held their value, or even thrived, during recessions. Remember, we are not financial advisors. Always do your own research and consult a professional financial advisor if you are not comfortable making investment decisions on your own. First up, let's talk about real estate. It's a topic that often comes up when the economy takes a downturn, and for good reason. Real estate has a unique resilience that other investments often lack. You know, the whole "they're not making more land" thing? It's a simple concept but incredibly powerful. Land is a finite resource, and as populations grow, the demand for it only increases. This basic principle underpins the enduring value of real estate. That still holds true, even in a recession. In fact, during economic downturns, real estate often becomes a safe haven for investors. While other markets may be volatile, real estate tends to be more stable. Now, I'm not saying every single property is a guaranteed winner, but historically, real estate has been a pretty solid investment during economic downturns. If you look at the data, you'll see that real estate often outperforms other types of investments like stocks and bonds during recessions. Think about it, people always need a place to live, right? Housing is a basic human need, and that doesn't change just because the economy is in a slump. In fact, the demand for rental properties often increases during recessions as people look for more affordable living options. Even if the stock market is freaking out, people still need a roof over their heads. This constant demand provides a level of security that other investments can't offer. Plus, owning property gives you a tangible asset, something you can see and touch, which can be incredibly reassuring during uncertain times. Plus, when interest rates are low, like they often are during recessions, it can actually be a good time to buy. Lower interest rates mean lower mortgage payments, making it more affordable to purchase property. This can open up opportunities for first-time homebuyers, or those looking to invest in rental properties. You might be able to snag a great deal on a property that appreciates in value over the long term. Real estate isn't just about the here and now, it's about the future. A well-chosen property can provide financial stability and growth for years to come, making it a smart investment even in tough economic times. Next up, we've got gold, the OG safe haven asset. For centuries, people have flocked to gold when the economy gets shaky, and for good reason. Gold is a physical asset, which means it's not directly tied to the stock market or the whims of central banks. When inflation rears its ugly head, like it tends to do during recessions, gold often holds its value, or even increases in price. Think of it as a kind of insurance policy for your portfolio. Now, I'm not saying you should go all in on gold bars and bury them in your backyard, but having a small allocation to gold, whether it's through physical bullion, ETFs, or mining stocks, can add some stability to your portfolio during turbulent times. The allure of gold isn't just about its shiny appearance or its historical significance, it's also about its intrinsic value and the effort required to extract it from the earth. The process of mining and refining gold is labor-intensive and costly, which adds to its value. This isn't something that can be easily replicated or replaced. Central banks around the world hold significant reserves of gold, underscoring its importance in the global financial system. These reserves act as a hedge against economic instability and currency fluctuations. Beyond its financial value, gold also holds cultural and aesthetic significance. From wedding rings to intricate jewelry, gold has been a symbol of wealth and beauty across different cultures and eras. Interestingly, gold is also a critical component in modern technology. Its excellent conductivity and resistance to tarnish make it indispensable in electronics, from smartphones to sophisticated medical equipment. Investing in gold can take many forms. You can buy physical gold in the form of coins or bars, invest in gold ETFs, or even purchase shares in gold mining companies. Each option has its own set of advantages and risks. Consulting with a financial advisor can help you determine the best way to incorporate gold into your investment strategy. They can provide insights into market trends and help you balance your portfolio to mitigate risks. Historically, gold rushes have driven people to great lengths in search of fortune. While the days of panning for gold in rivers may be behind us, the quest for this precious metal continues in more sophisticated ways. In today's world, secure storage facilities and advanced financial instruments have made it easier than ever to invest in and protect your gold assets. So, while gold may not be the flashiest investment, its enduring value and stability make it a wise choice for those looking to safeguard their wealth against economic uncertainties. Let's talk about bonds, the reliable, if somewhat boring member of the investment family. Bonds have been around for centuries, serving as a cornerstone for many investment portfolios. They are often seen as the steady eddy because of their predictable nature and lower risk compared to stocks. Bonds are essentially loans that you make to governments or corporations. When you buy a bond, you're lending your money to these entities for a set period. In return, they promise to pay you interest at regular intervals and to return your principal, the original amount you invested, when the bond matures. In exchange for lending your money, you receive regular interest payments and the promise of getting your principal back when the bond matures. This makes bonds a great option for those looking for a predictable income stream. The interest payments, often referred to as coupon payments, can be a reliable source of income, especially for retirees or those looking to balance more volatile investments. Now, bonds might not be as sexy as high-flying tech stocks, but they can provide a steady stream of income, which is especially valuable during a recession. When the stock market is volatile, bonds can act as a buffer, helping to stabilize your portfolio. They offer a level of security that stocks simply can't match, making them an essential component of a well-diversified investment strategy. Government bonds, in particular, are considered very safe, especially those issued by the U.S. Treasury. These bonds are backed by the full faith and credit of the U.S. government, making them one of the safest investments available. They are often used as a benchmark for other types of bonds and are a popular choice for conservative investors. They might not offer the highest returns, but they're about as close to a guaranteed return as you can get. The trade-off for this safety is lower returns compared to riskier investments like stocks. However, for many investors, the peace of mind that comes with knowing their principal is secure is well worth the lower yield. Bonds can be a crucial part of a balanced portfolio, providing stability and predictability in an uncertain financial world. Now, for those of you who want a little more growth potential than bonds offer, let's talk about dividend stocks. These are stocks of companies that have a track record of paying out a portion of their profits to shareholders in the form of dividends. Think of it as getting paid to own a piece of a company. Dividend stocks can be a great option during a recession because they provide a source of income even if the stock price itself isn't doing much. Plus, companies that consistently pay dividends tend to be well-established businesses with strong financials, which can make them more resilient during economic downturns. Alright, let's talk about cash. I know it's not the most exciting investment, but hear me out. Having a healthy cash cushion is crucial during a recession. Why? Because it gives you flexibility and peace of mind. If you lose your job or have an unexpected expense, having cash on hand means you don't have to sell your investments at a loss to cover your costs. Plus, having cash allows you to take advantage of investment opportunities that may arise during a downturn. Next up, let's talk about defensive stocks. These are stocks of companies that provide essential goods and services that people continue to need even during a recession. Think utilities, consumer staples, and healthcare. People still need to keep the lights on, buy groceries, and go to the doctor, even when the economy is struggling. Defensive stocks tend to be less volatile than the overall market, which can provide some stability to your portfolio during a downturn. Finally, let's talk about mutual funds. Mutual funds are a great way to diversify your investments, which is especially important during a recession. Instead of putting all your eggs in one basket, mutual funds allow you to invest in a basket of stocks, bonds, or other assets. This diversification can help reduce your overall risk. There are tons of different mutual funds out there, so you can find one that aligns with your risk tolerance and investment goals. If you're looking for a hands-off approach to investing, mutual funds can be a great option. So there you have it, the top 7 assets to consider investing in during a recession. Remember, recessions are a natural part of the economic cycle, but they don't have to spell disaster for your portfolio. By diversifying your investments and focusing on assets that have historically held their value during downturns, you can weather the storm and come out stronger on the other side. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more financial tips and insights. See you in the next video.